Hi, this is Randy Finney with Right Side of the Chart, and this is an early session, or actually now mid-session update for Monday, August 11th, 2025. It's 1:10 p.m. Eastern Time, so I'm starting the video. And here's what we're going to do, and roughly I'll try to keep it in this order. We're going to start out with just a few long side trade ideas that I've come across recently. I'll throw these out to you. Not going to get too nitty gritty into all the updates on the existing trades. Try to do that before I leave town. And I wanted to mention that I will be heading down. Have a Keys trip coming up. Gonna leave early Wednesday morning before the market opens, so I will be around through tomorrow and giving you updates until then. Not sure if I'm even going to bring my laptop down there. We're going to be fishing, lobstering, all that fun stuff, and I'm just going to be offline. If anything big happens, I'll get a post out to you on my phone, or maybe I will pack a laptop just in case. All right, so again, that's housekeeping. Let me go over a few trade ideas that I've come across, and then I'm going to get into some of the charts that some things in the charts that I may not have updated in quite a while. I'm going to look at some breadth indicators. I'm going to look at some of the important things that I'm watching right now, keeping an eye on. So let's dive into the charts here. This one stood out to me. I was going through last night, I'm sorry. I had sorted the stocks in the S&P 500 and the NASDAQ 100 by those above or below their 200-day moving averages. And I get into that when I get to breadth indicators. And anyway, in looking at these, here's one I came across here. This one's just recovered the 200s. This is APTV, it's a symbol, active. Looks like they're in the auto parts sector. And you have, as you can see here, you've just recently coming off a divergent low. As I've been making pretty clear lately, the long side trade ideas that I've been comfortable with and sharing with you recently are more of bottoming plays. This market, in my strong opinion, as a game of musical chairs now, the meme stocks are really usually the final icing on the cake when you have first a tech bubble, which we've had for a while going on, AI bubble, and then you have the meme stock mania going on right now in full throttle. And so again, I'm going to get some charts in a second. But for those looking for these long side trade ideas, you can see here, very simple. This was a divergent high, you got all that. There was a divergent low, you got that nice rally well into the double digits. And then most recently put in this divergent low, you had a nice primary downtrend line that I'm showing you right here off that high back in the beginning, late 2021 actually. And if I turn off all those annotations, you'll see the 200-day moving averages were just recovered right here. And so that stock has been testing in the bear market it's been in and recovered that. So one of the better looking trades. And then what you also had after you popped the trend line and the 200s, you came and back tested. I also have price resistance right here. And we just recently back tested the 200-day moving averages and that breakout. This is your first resistance level. We can call it a target if you want. We already hit it once, and then you can see these other lines. And again, I'm going to get into some charts that are going to show you that personally at this point in time, it's also a function of the fact I'm leaving town. I'm going to be offline, as I just told you, the rest of this week. Oh, and if I didn't state it, I will be back Monday. We're coming back. I'm coming back over the weekend. All right, so this is one, take it, leave it, your stop. And ideal entry would be somewhere around this 63, a little bit above there. We've already back tested it. So, if the market's going to hold up, which again, I'm going to show you some charts why I don't think it will very long. This is a better looking one. And these are all potential targets. I would right now at this point in time, you just have to take it as it comes. Let's say that $80 level would be, again, at this point in time. The technicals, I always say, are dynamic, meaning the charts are constantly changing, therefore so is my analysis. But that'd be about an 18% pop. And, if something else is going on here that in the markets, and we're going to go to new highs and beyond throughout the rest of the year and into 2026, sure, this one could go up to all these targets. Let me just fire off the rest. Again, if you like them, you want a screenshot on any of these charts, let me know. You can also pause the video, replicate these charts. Just make sure you put in log scaling. Here's Campbell's CPB, another blue chip stock. Campbell Soup, yep, down, beat down, but recently broke out above this downtrend line. Currently struggling, testing the 50-day moving average, but coming off a divergent low. And again, some of these, I also have looked at the weekly chart, if I didn't mention a lot of these, and can make a case there for long-term support as well. So there's that one. DOW is Dow Chemicals. DOW, yep, there it is. Already had it typed in. All right, Dow's beat down, positive divergence, but as I often say, divergence is not a buy signal or sell signal, whether it's bearish or bullish, but we do have the makings of a potential selling climax. It's still in free fall. Hard to make a screaming case to buy it. It's only been trading publicly under this ticker here for, going back to 2019. But we do have this previous reaction low. My guess is, again, this is a big if. If the market can hold up, these are the ones I like the best. And I'm going to get to some other charts and tell you, things I'll show you some things to watch for in the market and some recent developments. Again, some things I haven't covered. Those would be your two near-term targets. Actually, one more right here if you're interested in it. Again, right now there aren't any buy signals or really hard objective long entries other than it's in a selling climax. What will happen one day? You'll get a big reversal bullish candle. You can either step in now. If I were to take this one, I would only take a starter position now, adding if and when it gives some type of evidence of at least some half decent evidence of a reversal. UHC, United Healthcare, United Healthcare, UNH is, I always want to type in UHC. There's a nice divergent low. PPO is poised to make a bullish crossover. Hasn't done so. If it does so, that'll confirm that divergence. There's a downtrend line it can pop. I can give you one other micro level. Forget about these old lines. These are old annotations, levels up here. The stock was in a multi-year topping pattern right there, trading range. Had a failed breakout to new highs, a lot like what I suspect the stock market will end up doing there. And then, as I often say, breakouts that occur with negative divergence, overbought conditions, have a much higher rate of failing. And when you break out of a long-term trading range like that, once you fall back into it, that's usually the kiss of the death. And the next stop's not only the bottom of the range, but therefore on the other side. And that's what happened to UNH, again, United Healthcare. Long-term chart, I would like it better if it got down to this 209.80-ish level. Call that 210 because that's the next long-term support. In other words, this stock is in what I call technical no man's land, which is smack in the middle between resistance up there, 284.40-ish, and support. I much prefer to buy stocks at support. So if it does get another thrust down, again, as long as the market doesn't shit the bed, then this one, might have some upside potential. But again, I'm going to get some other charts. All right, those are out of the way. There's some more long trade ideas for you. You've had plenty of shorts also thrown out there lately. I, again, am a very strong proponent, at all points in time I am, but especially now, of diversification. It's been, in my opinion, tough market. If you're index investor and everything's in a S&P 500 or NASDAQ 100 index fund, great, but it is a stock picker's market. Again, I'm going to show you that in a second when we get to breadth indicators. More stocks are below their 200-day than above their 200-day. And that is a big red flag, my friends, when the stock market's ripping around to new highs and all the analysts are bullish and calling for no recession, great year in the market to come. Again, I'm going to show you these charts, and I'm going to show you how the market behaved in the past. You make your own decisions. That's what this site's all about. I provide technical analysis and trade ideas. You take that analysis, you take those trade ideas, you incorporate it into your own trading with your own analysis, and then you pass on the trade ideas that that don't fit your trading style, your outlook for that security. My price targets are just suggestions. You can have your own. Or, as I often say, you can go the other way. I show you key support and resistance levels that should, quote unquote, hold on a pullback, or if taken out, let's say on a downside pullback, that should trigger an objective short entry. So you can take the other side of all these trades if you want, if you're bullish when I'm bearish or bearish when I'm bullish, and utilize those support and resistance levels. That's kind of one of my key points is identifying those significant resistance levels that often trigger some type of a move, either a reaction, reversal off those levels, or a breakout if taken out. Okay, let's go into. Okay, we're going to wrap it up with breadth indicators. That's what I really want to cover some of those. But before we do, I'm going to show you the things that I'm watching. Again, it's not all inclusive, but the things that I believe are most important. As you know, unless you're brand new to the site, you've been following me, the 30-year. We are, as I continue to point out, this is a long term. As long as I can go back on this charting platform to the yield of the 30-year bond in the 70s, we're looking at here. And so, as I've covered many times, in my strong opinion, and it's not even opinion, it's fact, really. If you look at the definition of a downtrend, lower lows and lower highs, followed by trend reversal here, rates bottoming out, and then by every definition and technical analysis since COVID, we have higher highs and higher lows, all the makings of an early uptrend, and also took out a very well-defined multi-decade, nearly 40-year or 40-plus year. Almost 50 year, right? Yes, downtrend in yields, falling yields. Okay, so and again, that's where we're at right now. Hard to say where we're going to go. I suspect we'll break out, and if we do, as I've covered with you many times, there is no way. I don't care who you are. You could be, the most permeable and very intelligent, and you can't make a good case. Any case that breakout in yields to multi-decade highs. Remember, not just multi-year, multi-decades. We're going back. If we pop much above here, as I just showed you many times, the 30-year bond, the long bond, and then the 10 years usually not far behind it, have the potential to go back to where yields were back in the 90s or right around the turn of the century, millennium, right there in early 2000s. So again, that's what a breakout would do, and I promise you it'll be all over the media, and there's big significance too. It just puts the brakes on. It will show you that the Fed has truly lost control, and there's problems in the bond market which have huge implications, because again, it may not happen, guys. I'm warning them, just pointing out, watch it. If it happens, then it happens, and then how you may want to react to that, both your long-term funds and swing trading accounts. But it's going to slap handcuffs on the federal government in spending and a lot of other things, because it's going to be a big problem due to the massive amount of debt that we already have out there. And the Treasury can only play that shell game so long of trying to do more issuance on the short end of the yield curve. That can be a big problem too if they rely on that too long, which they've been doing for the last year or so. So either way, watch it. Again, it's very simple to track TYX as a yield, or if you don't even have that on your charting platforms, just look at TLT, the Treasury, the long bond, 30-year bond ETF. And again, if that happens to break the recent lows from right here back in late 2023 and the double tap, we just tested the highs and the yields there earlier this year back in May, and that would be your breakout there. Now on the flip side, if this happens, as I've covered many times, we can have a breakout in TLT, meaning yields are going down. That can be bullish if it happens on organic, meaning natural market forces. If this happens and treasuries break out and start ripping, meaning yields are dropping because the stock market's taking it on the chin, that's a flight to safety bid. And that, of course, is not necessarily or not at all bullish for the stock market. So there's, like I said, I have two scenarios where yields go down. One being bullish for the market if it's organic, natural forces, everything's okay, all other economic indicators are holding up. That's good. That helps a case for a longer bull market. Whereas, a flight to safety bid with a stock market crashing, also lowered growth expectations would bring yields down as well, i.e. a recession. Typically, long-term yields fall in a recession or the expectation of a recession. Whereas, again, I have zero alternatives if we break out to new highs in treasuries. I would love to hear if somebody can spin that as anything but bearish for the stock market. So we're watching that one, as you know, covered all the time. Just last week, started keeping an eye on, as I told you, BIZD. These, the pretty much the private. It's you have private equity, which we've all been hearing about lately in recent years, and now they want to, Trump wants to put them in 401ks. But then you have private debt as well, loans. So these are those similar type private equity companies stepping in and filling the role of traditionally what banks did, and your bigger lenders. And again, I already commented on this, so I'm not going to get into the nitty gritty, but there could definitely be some. If you're wondering what could just bring cause a big event in the financial markets, it could be this, because these guys, just like private equity, tend to bury losses. Think of Bernie Madoff. Think of I don't want to equate it exactly with a Ponzi scheme, but the same kind of thing. What Madoff was doing is just making up numbers on the client statements, so everything looked hunky-dory and everything was well. That's pretty much what private equity and private debt does. They get to value their assets, what they think, instead of having the public markets value. And so what happens when they finally have to sell something, when they're forced, and what happens, you can unwind that kind of bubble. And because once you have, a big position unloaded, it resets the market for that price. Think of the housing market. Think of Zillow. Think your house in your neighborhood. Zillow told you it was $1 million for last year or so. You hear that that home prices have slowed, and it's more of a buyer's market now than a seller's market. But Zillow may still have your house on around $1 million. But guess what? If 2 or 3 down the street suddenly sold same kind of house, same comps for 700,000, you're going to have a rapid adjustment down, and that's kind of how things work in the financial markets for these less liquid assets. Again, housing, I use that example because it's the same thing. If your house traded on the stock market, minute by minute, tick by tick, and you had millions of people buying and selling your house on the market at any one point in time, yeah, you'd have a very accurate value of what that's worth. But that's, like I said, the prices get reset less frequently in the real estate market. And where the biggest impact, guys, and on the economy and on assets, I'm talking to other financial assets, is that in an uptrend, you're assuming, just like I told you how the government, the reason you had these big revisions in the job numbers, in a strong job market and economic growth, they tend to, when they have to extrapolate and take guesses, as they have been with the, because the survey responses have plummeted, they don't have the staffing anymore. They've had staffing cutbacks and shortages. So the government has, as I've explained, you probably read about, relied on more and more imputed data. In other words, just wild kind of guesses. And that tends to skew in a strong, market with falling unemployment, as we've had for many years until recently, that tends to overstate or give you a more bullish or positive picture of the market. But so when things finally turn, my point is, and the revisions start coming in, that's why, and I don't have it queued up, but I've showed you many times, please pull it on your own, look at the unemployment charts, historical, go back as many years as you can, and you will see, as I've showed you, when unemployment, the jobless rate bottoms, it doesn't do this. It's never done that. It V's out. And so it's a pretty quick turn. And so we'll be watching that. I'll be gone this week. We have employment numbers coming out later. It's either Thursday or Friday. Pretty good economic calendar this week. CPI tomorrow. And so watch that. That'll also most likely impact interest rates and treasury bonds. That's tomorrow morning. And PCQ. I'm also watching California really close. I think the big shoe to drop. I'm not the only one that's pointing that out. For years we've known this. Pension funds in the U.S., public pension funds, are grossly underfunded. Anything above 90% or above is considered well-funded and healthy. Historically, the number is somewhere, I believe, just south of 80%, and including CalPERS, that's the largest in the country. CalPERS, the California Public Employee Retirement Pension Fund. And as I've stated before, and I'm picking on CalPERS, taxpayers in California are on the hook for any shortages. The local government agencies will be said they have to make up any shortfall, because those pension benefits are guaranteed, and it's huge. And so I'm watching the California market as a proxy. Why California? Well, first of all, not I mentioned CalPERS is the biggest pension fund, public pension fund in the country, and California is the biggest state economy in the country. In fact, it's bigger than most global economies. It's, what is it, like, I don't know, last time I heard, like the sixth largest economy in the world. And in other words, there's 5 countries larger than the state of California's economy. So it's a big one. So we'll watch that. And again, what's going on here? This is just one of many. Most of these are pushing multi-year or multi-decade lows where yields break down. So remember, as I told you earlier with treasuries, prices and bond prices and yields move inversely. So look where a lot of California bond funds are at. They're pushing where they drop and they break this nice support here. You have this descending triangle pattern. You're going to take yields out to multi-year and even multi-decade highs. And that does have a big impact. That's borrowing costs. This is how the street lights, the schools, the teachers that your kids are going to school, the street lights on at night, the police that keep you safe, the fire department that comes when your house is on fire, all these things need to be paid for by these public services. That's a big thing there. So what happens is when yields go up, the cost of capital goes up. And so again, a lot of this stuff, again, we're sitting right on the line, and the tech bubble rages on as if there's nothing wrong. In other words, Nero fiddled while Rome burns. And this hasn't happened yet. We haven't broken out. Look, guys, we can do this. And again, if it happens, natural organic forces where California bonds start to rally, yields drop, well, that helps, because then the state can continue to finance their obligations, and at cheaper costs of capital. All right, what's up next? That's the yield curve. Let's talk about that. Okay, from time to time, I cover this. This is the yield curve. For those of you not familiar, I would recommend to look it up, or you can come here and check this site out. This is Guru Focus. They talk about what it is. Basically, it's the differential between what short-term and long-term treasuries. So on this site, they give you the 10-year to 1-year spread and the 10-year 2-year. So it's just 2 different variations there. Again, these are treasury bonds, and this has been for many decades considered one of the most reliable recession indicators out there. It has had a 0 failure rate. And the funny thing is, guys, I bury myself in news feeds, read a lot of articles. I haven't heard a peep about the yield curve in a while. Everyone stopped talking about it. It's almost been written off as if this didn't work. And most of that reason is when I listen to these so-called experts talk about it on CNBC or wherever else, in some articles, they seem to miss the fact it's not the inversion. They talk about it because we inverted here a couple years ago. There was a lot of buzz about it back then, but it's never been the inversion. That's part one. Part two is, for the timing, is the uninversion, when the yield curve moves back above the 0 line. In other words, uninverts. And so if you're not familiar, meaning, a normal yield curve, you're going to have longer term bonds paying a lot more than shorter term bonds. That's a healthy economy, healthy environment. It only makes sense. And so, again, pull this chart on your own. You'll see it's the uninversion. These shaded areas, if you can't see it, you need to, go to a site or, get a better monitor. Maybe you watch on your phone. These shaded areas that I'm highlighting here are all the recessions, every single one going back to the 70s without an exception. And there's a little skinny one there when COVID hit. Remember, I call it Ursa Interruptus, a bear market that was interrupted with massive stimulus, fiscal and monetary, by all central banks, not just the U.S., and all central governments, not just D.C. All right, so that's it. And so you can see without it's yet to fail. We just fairly recently uninverted. So according to this, again, maybe this will be different this time, but the yield curve without fail has predicted the past 7 recessions. And maybe if we go, let's just say we go 2-3 years now without a recession, then I think it's safe to say this is no longer effective. But as you can see here, we've just fairly recently uninverted. And so by that logic, a recession's most likely coming. And again, I didn't cue this chart up, but I've showed it with you in the past. Also, Fed fund rate. Everybody now, the market is rallying on hopes because of those huge job revisions. You know, the one where Trump fired the head of the BLS because he didn't like the revisions. But what they said is the shot that now we have what is it, like an 80-something% chance of a rate cut next month. And the funny part, I've showed you, the beginning of rate cutting cycles is typically where recessions follow as well. So there's so many things pointing. You know, that simple-minded folks say, oh, okay, lower rates, that's going to be stimulative for the stock market. Not if rates are being lowered because we're heading into a recession. And again, the job market is the one thing. Consumer spending being about 70% of GDP. So the job market continues. Just watch that trend. Those are what I'm watching very closely here. Let me show you the economic calendar. And let me zoom in a little so you can see a little better. All right, so this is it. I'll be around tomorrow. CPI comes out in the morning. I'll be gone Thursday. We have jobless claims, one the market will watch. PPI, final demand, Fed's preferred gauge. Retail sales is a big one. Industrial production. And you have a whole bunch of Fed mouthpieces going to be talking this week. And so that's something. You also have some 20-year bond announcement. That rattled the bond market a month or two ago when they had a poor auction. I've been tracking the auctions too, and the last couple auctions in the 30 and 10 year also fell well below demand and came in hotter than expected. And so we're kind of seeing some of those warning signs. Again, watch the fixed income markets. They're very, very important. It's a way to glean some clues into the equity markets. So, all right, let's jump over to. We're just going to look at some of my market breadth indicators. Okay, that kind of tells you, hey, how do things look under the hood? A strong rally should have good breadth, participation, market breadth, meaning most stocks should be going up in a bull market. And when you have fewer and fewer doing the heavy lifting, which has been the signature for as long as I can remember, the signature of a topping market. Now the problem is if you just wait for seeing the Mag 7 or Mag 8 outperforming the or the regular cap weighted indexes outperforming the equal weighted, you don't start selling then. You're leaving a lot of profits on the table. You need some sell signals. Those I've covered many times, what we need to see in the charts, including not limited to a break of the lows from a couple weeks ago, a few weeks back in the indexes. We still have the bearish engulfings and some indexes as well. But this is Apple, all right? Apple still, NVIDIA might take the lead right now in market cap, but Apple is Apple. Apple is a much more diversified, in my opinion, more important. NVIDIA, yeah, it's the poster child of the AI bubble, and it is certainly a very important stock due to the weighting in the S&P 500, NASDAQ 100, both mathematically and again psychologically. But Apple is Apple, a much more established, diversified company. And all I'm going to just, again, you do what you want with this chart. This is an old chart. I've had it for years. Made this years ago. Corrections have followed divergent highs as well as tags of this blue line just above the 25% level. Okay, so I created that probably back here. I can't remember where. What you're looking at, guys, by the way, is the percentage that Apple is trading above its 200-day moving average. So what I did down here years ago, I figured out how to replicate or create custom indicators that will show me if charting platform doesn't already have it in there. I just tweak the PPO. I play around with the numbers, and you can come up with an indicator that will show you what the percentage is of any given stock above its 200-day moving averages. In this case, I use the EMA, the exponential moving average. Tends to do a good job on Apple. And so what you're looking at here, the higher this is, it's in percentage terms. You can see my scaling from about 80 down to 60. So right there is a zero line in the middle. So if you're on the zero line, it means Apple's trading on its 200-day, right? Okay, so what I look for is, or have been, are these divergences. And you can see them measured out here. If you can't, I'm going to tell you. So that was the first divergent high where Apple was going up in price and this percentage above its 200-day was declining. So that was followed by a 43% correction, then a 60 bear market, and then a 62%, 45, 57, 26, 40, I'm rounding off, 36, 36. And what I want to show you here is this right here is the biggest divergence that we had. Let me change its color up. This is the biggest divergence Apple has had on its with the percentage above its 200-day versus price since back here. That was leading up to the financial crisis. That was the by far biggest correction or bear market in Apple in many decades, right? And so all I can tell you is that's a, it just kind of shows you, that the momentum in the rally is waning. It trades less and less. And of course, it's recently, for a while, it's been below its 200-day moving average. It's played a little game of catch up lately with that, as I already commented on. I think it's ridiculous, the fact that Apple's going to commit even more money, another $100 billion more, to onshoring production in the U.S. Yeah. So anyway, don't even get me started on that. I mean, fundamentally, yeah, you might be, dodging some tariffs, but if you look back a couple of years ago, is it a net positive on the stock or still a net negative? It's a net negative. So either way, I just want to show you that chart. Now, we did just recently kiss this line right here, which has contained most of the pullbacks on that indicator. All right, so I just want to point that out, that I had a green line here that in recent years has contained that indicator. Now, it wasn't when you immediately bottom was close thereafter. But we also had a level right here preceding that previous bear market that would contain all pullbacks. And so if there's a major top in Apple, you see it was good for a rally, the first bear market rally, which that's all this is so far. Then came the biggest leg down, and that indicator or that level was taken out by a wide margin. Just keep in mind, remember, there's no hard and set formula, but typically the bigger the scope of divergences, these are multi-year divergences, typically the bigger the ensuing trend change when it finally comes. So keep that in mind. All right, I've got a couple more for you here, and we'll wrap this video up. Not too many. We're almost done. Okay, this next one here is one of my favorite indicators I've been using for many, many years. And it's the NAAD, which is the NASDAQ Advance versus Declining Issues. And so what I look for is in a healthy rally, and you should see the number of advancers outpacing decliners. And you'll usually see that coming off a bear market. Over time, this indicator will decline. And the reason it does is the NASDAQ composite has thousands of stocks in there, over 3,000, I think it is. And there's always some dropping out. However, so you'll see over time the NAAD will continue to fall, but in a strong advance, which you see after corrections and bear markets are over, it is rising along with price, as it should be. And so what happens is it starts to diverge, but like anything, divergences aren't a sell signal, but they're a condition. They're a condition showing you that fewer and fewer stocks, in other words, when it's diverging, more stocks more stocks in the NASDAQ are falling than rising. So you can see in the dot-com bubble, there was huge, stark divergence. This was a kind of a rare, that was the dot-com bubble. We all know about it. And then that was a almost 80% bear market in the NASDAQ composite. It was, I think, 78, close to 80% drop. Wiped a lot of people out, especially those chasing speculative stuff, and in the mindset as they had been for a while. It was Pavlovian, classical conditioning 101, Pavlov and his dogs. Dinner bell rings, the dogs salivate, even if there's not food put there in front of them anymore, as he initially did. Dip buyers will buy, and they'll buy all the way down until they realize something's wrong, then they capitulate at the bottom. So that was bear market one. This was the financial crisis. That was still a 55+% drop in the NASDAQ and the S&P 500 back then. But you can see, all I can tell you, again, I'm showing you the charts. We had big divergence, multi-year divergence leading up to the financial crisis. We had multi-year divergence leading up to this correction near bear market. Not small divergence, small drop. 2015 to 2017 was a almost 2 year sideways market with two corrections that were almost 20% each in the NASDAQ. That was also leading up to that period was preceded by divergence in the NAD. COVID, like I said, you can call it a random black swan event, but as I've covered many times in the past, and we were short for it, the charts were indicating a bear market was coming. We had the divergence there as well. And then again, without exception, I'm showing you all the divergences. I pointed it out here back before the big drop, the 2022 bear market, clear negative divergence. We had a bear market. And what happened since then? This whole, we had the rally that we've had. The NASDAQ made new highs, the NASDAQ 100 up top. But yet this line has continued to fall. And I noted here before, I've added this and shared this with you, there's a final kind of that last gasp. The analogy I use is sometimes you have a patient in hospice and they're dying, they're not doing well, but then they had that brief moment of lucidity, and they get have a great talk with the loved ones, and then boom, right before they die. And that's kind of, you see that in the market quite often, a little like a last minute kind of hurrah before the peak is in. Either way, all I can tell you, and this is not a subjective measure, this is clear divergence, big divergence. Divergence not seen, and this is the important part. This is why I do this, and this is why I'm still talking what I was talking back here. And it's not as if it didn't work. We had a nice hefty correction there. We had a big one back there. But my point is, this divergence is only rivaled by what we saw leading up to the financial crisis back in 2007-08. And just like that, I remember back then, folks were, the majority of pundits were every bit as bullish on the outlook for the market then as they are right now. So all I can tell you is things change, and things can change and often do rapidly. And when risk isn't properly priced in, and there's not enough hedging and there's not enough shorts in the market, that's what allows for these relatively quick swoons down, these fast bear markets, fast corrections. All right, either way, the chart is what the chart is. So we'll see if 6 months from now this divergence is even bigger. I'm going to be covering this same chart with you. I'm going to tell you the divergence is even larger now. However, maybe something else is going on here, something I've never seen, and maybe we'll start moving up and we'll start participating, and the majority of stocks will participate. But let me move on to a couple more charts. I think these are definitely worth looking at here. Okay, as I was going through my breadth chart, I didn't have this one down on my notepad to cover with you. I have a lot of different breadth indicator charts, so this is one of them. Here, I think you can see just at the top there, it says NAHLR. That's the NASDAQ new high to new low ratio index, right? And I haven't updated it because I wasn't planning to cover it, but I might as well. I just caught it. I've covered this many times in the past. These are your divergences. In other words, you should have in a good market more highs than new lows, right? Makes sense. And so when that starts diverging, you can see every single divergence, all these red boxes are the corrections. I didn't use log scaling here, guys. These corrections, it makes this look like nothing. That was a 55+% drop, the bear market financial crisis. There was COVID, there's some big ones there. So it makes this 2022 drop, which was far less, look bigger. So just keep that in mind. But the takeaway is, without fail, I'm showing you the divergence. I've showed you this chart then. I showed it leading up to there, and it worked here, worked here. That was the last correction we had earlier this year. Again, it looks bigger on here because this is not log scaling. Log scaling will equalize everything in percentage terms, not point terms. Because when you have a $20,000 index, a 1,000% move is much smaller than a 1,000 point move on a 2,000 point index, which is a 50% drop, right? Much less there. So that's what log scaling fixes. Now, what I want to show you is the divergence has carried over. We put in a new high in the NASDAQ without new highs here. We still have that negative divergence at this point in time. So what happens if we start popping through these divergences, then maybe something different is going on. Maybe we are in another 1999-like bubble, and we're going to just keep going up for a while. Okay, the last couple I want to show you are the percentage of stocks above their 50-day and 200-day moving averages. This is the 200-day. I have several variations of this chart. You can see, again, these blue lines right here, all these, and I put little dotted lines to show you where the top came, and I measured the moves. I have to go back a little further. We had divergence leading up there. There was that 78% bear market in the NASDAQ. Remember, you have the NASDAQ composite up top, and the percentage of stocks in the NASDAQ trading above their 200-day moving average. So again, to read this chart, the 50 is equal. So when you're at that 50 line, when this line's on the 50 level, half the stocks are above their 200-day moving average, the other half are below. So it would stand to reason that the NASDAQ 100 being at new all-time highs, or the NASDAQ composite, I'm sorry, I'm using the composite, has more stocks in there. You would think that you're going to have the vast majority of stocks going to be above their 200-day moving average. It's not. This is a screaming red flag as far as market breadth goes. It's being ignored because the indexes are being lifted and everybody's happy. But again, and it can continue for some time, but you can kind of get an idea on here. Just look at the past history. It doesn't continue forever. And we've been in a super secular bull market. The last divergence, this one was pretty steep right here, led to that 35% drop right there, right? And it ended with a little divergent low. You can also see here, this is where I have annotations on this chart, and it says, let me box it in here. Let me change the color here. This is where big corrections typically end, at this line right here. And I have a purple line down below. This is where bear markets end. So we know, the financial crisis was certainly a bear market. COVID was a bear market. If you blinked, you missed it, but the S&P was down 36% in about 6 weeks. And again, these are where corrections in recent year ended. And that's what happened. 2022 was really just, in my opinion, a correction by that old antiquated definition of a drop of 20% or more. Sure, it was a bear market. But we only hit the correction level there. You can see this last drop didn't even register, didn't even hit where corrections usually end. So it didn't purge out a lot. Either way, this is what I'm focused on the most right here. This stark divergence right here with new highs in the indexes and the percentage of stocks, again, in the NASDAQ composite. 37% of stocks are trading above their 200-day moving average, which means over 40%, nearly 42% right now. It's 37.7, so 38%. I'm sorry, 62% are trading below their 200-day moving average, which is when you're looking at market breadth, that's just a red flag. And, historically, I've never seen this kind of fix itself where you start seeing that. If we do get it, that's going to be healthy. In other words, if the majority of stocks, with that 2/3 of stocks that are trading well below their 200-day moving average, if they start to rally and perform, and that's also why I'm kind of focusing on those stocks right now that are beat down. I'm sticking with the brand name stuff, more of the blue chips. But I've been throwing out a mixed bag of stocks, some of them more speculative than others recently. All right, so that one's pretty telling in my opinion. And again, divergences are not buy or sell signals, but it just kind of shows you what's happening in the market if the vast majority, nearly 2/3 of stocks are trading in the NASDAQ are below their 200-day moving averages. And we're not even close here. That's not healthy bear market stuff. When you have a strong rally, you should have the majority of stocks trading above their 200-day moving average, which is what you had here, these early rallies. Another way to say it, this is just late stage bull market action. Here's a slightly different variation of that. This is up top. This is QQQ. So on the very top here, the NASDAQ 100 tracking the ETF. Remember, we were looking at the NASDAQ composite a second ago. The NASDAQ 100, just the largest 100 companies in there. And what I have here is the percentage of stocks in the NASDAQ trading above their 50-day. This is the NAA 50R. So this top chart here shows the percent of stocks in the NASDAQ above their 50-day moving average. So again, here's your 50 line right here. So when you're in this top half, you're above the 50-day. And the higher the line goes, the more higher percent of stocks. Right there was a peak where you had a big whipsaw when COVID hit, and you peaked out almost 90% of stocks. That's very rare. We're trading above their 50-day moving average on that initial rally off there. And that's very strong. That's a strong, very positive breath. So Down below on the bottom, you have the percentage of stocks, which I just showed you in the NASDAQ, trading above their 200-day moving average. So as I just showed you, 37, almost 38%, well below. And here's the thing, since this whole peak back there, and we were, heading up there was pretty healthy. This rally coming off the COVID was healthy all the way through right here. Nice market breadth, as it should be. A lot more stocks when the market was going up, trading above their 200s and 50s. Then something happened. Starting at this point right here, you can see my divergence line. From here to here, we kept going up, but all of a sudden, the number of stocks trading above their 50 and 200s was going down. Again, that was a precursor to that correction, which we timed our entry based on other things than this. But I covered this back then, showing you that, hey, market breadth is poor, internals are poor. This rally is most likely unsustainable based on this. That's throughout history. It's never been a sustainable rally when fewer and fewer and fewer, and then just a handful of stocks are doing almost all the heavy lifting. So big correction there. And that's all I can tell you now. Since this rally off that low, this whole rally, yes, I've been suspect of it, trying to pick the top, and I'm not giving up. My convictions right now are every bit, if not stronger than they were when we first started and you had that bounce target zone. Remember, we gamed the first half of that rally off the bottom, long covered shorts there. I'm sorry, that was off this one. I'm sorry, my bad. That was a whole other thing. We were long back then. That was 2023. I'm talking this last drop, the Trump tariff correction there. We gamed it down. We covered shorts. We gamed the first half up, and now I'm looking for, and by almost all these breadth indicators I look at are saying the same thing. And again, these are things going back for many years. These are almost immutable facts, really, what's going on with the market. And again, I don't think, maybe sometimes they march somebody out. Nobody wants to hear this right now in a rising market. They don't march the bears out as much on CNBC and Bloomberg. And if they do, they kind of get shot down and ridiculed and whatever. So I'm just showing you that the longer these conditions persist and the more severe they get, typically the more powerful the ensuing trend change, i.e. correction or bear market, when it finally sets in. So again, this is multi-year divergence. We haven't seen divergence of this scope. This is even bigger than it was leading up to the financial crisis back here, all right, in 2000, the peak in 07 when the market peaked into the 09 lows. So there's that. And so if I didn't cover it, I already covered the about 38% of stocks in the NASDAQ are trading above their 200. As I said, it was, you never really got above. This whole rally has been suspect. Again, it's all the tech bubble, the AI bubble, and now there's some meme stock bubble going on, but they don't move the market. The meme stocks are, their market cap's so small, it's just kind of a trait what's going on right now. But this shows you that throughout this entire rally, breadth has been suspect. Why haven't we broken above that 50% barrier where half the stocks certainly should be? When you broke out, this was new highs right here in the market, and we've been at new highs since, a couple corrections. But yet we keep seeing fewer and fewer stocks trading above their 200. And now look at this final little hurrah since the April lows right there. That's where we reversed, covered, tried to game the first half rather than start short and picking tops. You can see this, even the percentage above their 50-day has been declining and has now dropped below. So you have 44, as of Friday's close, 44.5% of stocks are trading above their 50-day moving average, meaning you have more stocks below it. And we just crossed down below that. As if you look closely, the market going to new highs there. So again, these are breadth indicators. They're flashing warning signs, if you will. They're not timing indicators. Timing indicators will be what I've covered in the past. We need to take out the lows from a couple weeks ago. And let me see. I think that's... Oh, yeah. One more I'll show you. And then we'll wrap up. Okay, last chart. We'll wrap this up. This one, I don't cover it often. This is a variation of the Hindenburg Omen. Hindenburg Omen was popular back before the financial crisis. It predates that, but then we started getting quite a few signals fired And I made my own variation of it because the Hindenburg was based on the NYSE. And I long ago felt and discovered that the NASDAQ was more important. The NASDAQ is just as I've always said, a more concentrated view of the S&P 500. The S&P 500 has more sectors. It's much more diversified. But tech is still the largest component of the NASDAQ, S&P 500 by far, twice as much as the second largest. And so what you have in the NASDAQ 100, it's more concentrated with the same top holdings of the S&P, the ones that really and ultimately and arguably determine the performance. Again, so what you're doing is stripping out by focusing on the NASDAQ with breadth indicators and things like this. I can strip away utilities and REITs and other things that just cause noise in there and look at the stocks that matter. Again, you add up the market cap of the Mag 8 top 10 holdings in the NASDAQ 100 or S&P 500, it dwarfs everything else. So this is my own custom version. I just took the same criteria from the traditional Hindenburg indicator and mapped it over using everything related to the NASDAQ instead of the NYSE. So this is the NASDAQ McClellan oscillator. One condition is that McClellan oscillator has to be negative on the same day. And again, I plugged in instead of the NYSE, the NASDAQ McClellan oscillator. And so that's condition one. All these conditions have to be met. And it's very, very rare. And I did, before that big drop, before the Trump, and I covered this, I believe at the time, I had a few signals fire off before that liquidation day when Trump came to the podium to announce his, tariffs. I haven't had a signal in a while, guys, and I've had two in the last week. So the next criteria down here, the daily number of new 52-week highs and the daily number of new 52-week lows are both greater than or equal to 2.8% of the sum of the NASDAQ issues that advance or decline that day. In other words, right here, so I have this little blue line. I think you can see it. That's at 2.8%. So these are advances. So we had a fire, boom, boom. That was that would have been that's Friday. So that would have been Thursday. We fired right here. We had a check mark here, check mark there, and we also had a trigger right here. Actually, two triggers, and that's what you want to see. And this one down here, it says the number of 52-week highs cannot be more than twice the number of new 52-week lows, though new 52-week lows may be more than double new. So again, I didn't make this up. I'm not taking credit for the Hindenburg indicator. This is my iteration or variant of it. And that met. So you got that criteria. And finally, the NASDAQ composite is greater in value than it was 50 trading days ago. Originally, this was expressed as a blah, blah, blah. Well, you can read that there. And we certainly have that there. So boom, I want to just say multiple hits. By the way, guys, I didn't invent it. It's a crash indicator. And when you get these, it doesn't just it indicates the probability of a crash is high. And you can read up on it. Again, it hasn't been talked about in years. I think because we had a flurry of signals afterwards with all the market distortions. After the financial crisis, the government came in, or the Fed and the federal government came in with so much market intervention. And I think it kind of distorted and there were enough false signals. People kind of got away from this. But I keep an eye on it. And again, it's one of many breadth indicators. That's why I do these long-winded videos. There's not any one single breadth indicator or one indicator of anything that is 100% accurate. So when I do these long-winded videos, I'm showing you I like to look at a preponderance of evidence. It's kind of like I always say, a criminal defense case. The prosecution has to prove beyond a reasonable shadow of a doubt that the defendant is guilty of the crime or they don't get a conviction. And so they don't go to court with one or two things. They want to build a big case. And so all I'm showing you here, and I know some of you are very tired of hearing this and the market keeps going up. And again, the takeaway is you don't just take all your money and start shorting the market immediately because of these things. It helps when you finally get the sell signals that we've been waiting for. Again, the next one's going to be, as I've been saying, and go to the 60-minute chart, a break of the recent lows from, that was Friday, August 1st, and that was also, August 1st. This is what I've been saying now since then. We need to take out, that was the first downside target area or support area, and So this divergent high, I just take this, move it over here. So nothing's changed. Yes, technically we made a marginal new and slight high in the NASDAQ 100 here, QQQ. There's a little near-term uptrend line. And so that a break of that will most likely trigger a sell-off. But this is a level that I think when it goes, as I've covered, you have a big old thin zone. It's going to start a more powerful drop. And as I've covered in recent videos too, QQQE, the equal weighted, is far from a high. So what you're seeing here is, again, it's a signature of the final throes of a bull run where just the masses have capitulated and have resigned themselves to the fact that NVIDIA is always going to just keep going up. You just want to keep buying NVIDIA and the big mag whatevers. But this is showing you, as I just spent a lot of time showing you, the vast majority of stocks are not going up and they're not participating. And so again, the equal weighted indexes will show you that. The S&P 500 and NASDAQ 100, they're singing a different song lately. And it's a pretty rapid deterioration. And that's usually what you see at the top there, again, of, clear correction, reversal in the equal weighted indexes. RSP is the S&P 500 equal weight, which has failed to make a new high. Whereas if you put the cap weighted, the S&P 500 is still at a high, but still below its bearish engulfing candle from on the daily chart, as well as the weekly chart right now. So the broad market's still below there. And that's it. That's all I got for you. I'm going to wrap the video up here, get it out to you, and I'll do my best to get to any questions before I leave town. Again, Wednesday morning, so I'll be here today, tomorrow, and then out of town for the remainder of the week. This has been Randy Finney with Right Side of the Chart. Have a great day.